Hey, my brother. How you doing? You muted.
How are you, Hutch?
I am doing great, sir. I'm doing better now.
Excellent. Some challenges there, it seems.
Oh yeah, life always gonna be challenges. Always
Sounds
gonna be
good.
challenges. Okay,
Glad
Heath
we
is it?
resolved it. Mhm.
Yes, I think everyone's back. Is everyone back from the breakout room? Heath? Oh,
I don't know. I don't know if people are, if it was going to be another minute once everything's closed out. We did have like 30 some odd people.
yes. Got another 20 seconds. They're coming in.
Okay.
Even as smooth as the airplane flight is, there's still friction there, right? Yes, sir. So you just came off vacation, or you going on a vacation soon, Neil?
I am going to Hawaii and then
What?
I'm going to Europe after that. So, well, I've got both shots now. I got Pfizer, my second shot. So,
Okay,
time to fly.
nice. So when you go to Hawaii, will you be required to go into quarantine at all?
No, because we will take a test 3 days before.
Got you. Okay. So you don't get to sit in a hotel for 14 days.
Nope. Well, there wouldn't be much point of going to Hawaii.
I know, right?
Yeah.
Man. Um, yeah, so we had about almost twice the people that we have right now. Um, but it's really great. So patient, right? There's a patient is a virtue, right?
Mhm.
It pays out. So Heath already talked you up to be this magical, mythical, spiritual being amongst us.
Okay.
Yeah.
I'm far from spiritual. Um,
Yes, sir. You got a PowerPoint for us, right? Just me and the
Yep.
co-host. Okay. Yes, sir. So, ladies and gentlemen, without further ado, the mad scientist of the multifamily, Mr. Neal Bauer.
All right. Welcome, everyone. Let me get started here. I am going to share my screen. So give me a second just to get set up. All right. I want to do my slideshow on the second monitor. There we go. And then I want to share my screen with you guys. Where is the Zoom link? Zoom, there we go. Share screen. Screen two. All right, let me know if you can see my screen. Yes, perfect. All right, this this is the 2021 trends presentation, which is really about all of the things that are happening in the industry at this point of time over the next 12 months. There's a lot of prediction involved. A little bit about me. I am a opinionated and quirky data scientist, a technologist. I buy and build large projects, multifamily, student housing, industrial, self-storage. These are some of my favorite watering holes. Our portfolio of 20 properties in 10 states is worth about 400 million. And I love to teach, but I love to explode myths. And I'm going to be doing a lot of that today in this presentation. Here's a little bit about our portfolio. Top row are townhomes, middle and lower rows are apartments and student housing, and also some industrial projects. But we know cash flow is important, so the other half of our portfolio are ugly duckling, multifamily, and self-storage projects for cash flow for our 500 plus investors. And speaking about happy investors, track record matters a lot more than a big portfolio. So it's great that our investors are kind enough to write reviews for us once they've completed projects with us, like this review from Sarah, who's got 4 active projects with us, and Ivan, who's got 6 active projects with us. All right, after some of that chest thumping, let's get to the matter at hand. No review of 2021 trends is complete without a review of the year of misery. COVID caused more Americans to move than ever before, and those migration patterns are where our story begins. We will connect these patterns with some economic tea leaf reading. From GDP to interest rates to stimulus, we're going to connect it all back to real estate. And then we get to the forecast. Single family, apartments, other asset classes. We share class leading data from CBRE, Yardi, Zillow, the Federal Reserve, and a dozen other sources. And we finish off the most popular section with the most popular section, the shootouts, best cities for real estate investment. The final couple slides are dedicated to my personal picks, one national city and one underperforming city that should do really well in 2021. Before we get to the content, here's the boring stuff from my lawyer. Educational webinars doesn't squeeze out the risk. My recommendations are not magic, they're opinions. Do your own due diligence and consult professionals before you invest in real estate. Okay, our story starts with a flashback of how the economy did in 2020. Let's take a look. I'm a real estate guy, so I start with what affects my investor profits the most, rent growth. Before the virus, rent growth in the US was rock solid at 3%, with all types of asset at or above trend rent growth. In fact, annual rent growth in the US had grown for a record 39 consecutive quarters. That's a very long time. Occupancy was an all-time high. And then all hell broke loose. The virus plunged us into a recession. It killed 550,000 Americans, caused catastrophic damage to our services industry. But for once, maybe only this is the first time, Congress responded spectacularly well with the initial CARES Act. So with the Fed's interest rate cut and the trillions in stimulus, we saw the stock market and the real estate market go absolutely bonkers. And today the S&P 500 is above 3,800, its highest ever, despite a second and then a third resurgence of the virus. And I know there's lots of you on the webinar who think that the stock market doesn't make any sense. Millions of Americans are out of work, so the stock market's too high, it's going to crash, Neal. Well, the truth is, the stock market is actually where it should be, and I'm going to prove that to you in less than 10 minutes from now. The first place I'm going to dig is GDP growth. The US gross domestic product was negative 33% here in Q2. That's the highest decline on record. I see that in news articles all the time. You know what I don't see is that Q3 GDP growth was not negative, it was positive 33%, the best ever. So all in all, Q2 and Q3 actually canceled each other. And while that doesn't make sense to you yet, it will in a few slides. Okay, so GDP balanced out. But many other industries were hit hard, Neal. The 4 largest US airlines lost 25 billion. The NFL lost 38% of their revenue. So many sporting and event venues have been closed. The 2 largest theater chains in the US are both going to be closing. And yes, but the government responded to this pain with the largest economic stimulus in US history. $2 trillion were injected, and the Fed didn't stand back either. They increased their balance sheet by a staggering $4 trillion in the last 12 months, and they lowered interest rates to 0. So yes, there was pain, but there was an incredibly appropriate response. Now, having said that, the unemployment picture was horrible, right? You can see in the chart here in this cluster, the last 5 recessions, their first 52 weeks, that's what they look like. And then you see this recession, right? A year after the orange line here is the 2020 recession. Only 31 weeks into this recession, we're already at 66 million unemployment claims. So that's a stunning number. That's the bad news. Another thing that was bizarre was how uneven this recession is. Hawaii is at 15% unemployment, Nevada at 13%, but there are 14 states that are under 6%, and in the last few weeks have dropped under 5% unemployment. So very uneven. The recovery is also being bizarrely uneven depending on education level and income. On the left, you can see rich people down, back up, right? From a perspective of bachelor's degree or more. Well, high school diploma, no, still way down there. Once again, here you see high income, middle income down, back up, whereas the low income levels are still struggling. So bottom line is that people with low incomes and low of education suffered the most in this recession. Tourism states suffered the most, while many parts of America have lost very few jobs. With that background, let me jump into the favorite 3 slides of my presentation. This is the big aha moment of this presentation that I really enjoy doing. The biggest thing that we think is holding investors back today is that they cannot reconcile the suffering of tens of millions of Americans with these skyrocketing stock and real estate prices. So they're on the sidelines because they keep thinking something's hugely wrong with the economy. And I was one of those people. I sat by the sideline for months, and then I decided to investigate. And here's what I learned. The first bar on the left shows how much the economy gained or lost in terms of wages. You'll be shocked to learn that the economy only lost 43 billion in wages during the first 9 months. Why? Because income inequality in the US economy is so high that the people who have low paying service jobs are only a tiny fraction of the US economy, a very tiny fraction, right? And yes, they are going through incredible pain, but in the big picture, these people unfortunately matter less. I know it sounds horrible. It's true. So $43 billion lost, still a lot of money, but they were gains. The second bar shows the unemployment benefits that came in from the CARES Act, right? 25 times higher than 2019, 25x, a total of $500 billion. And then that doesn't include the $1,200 stimulus checks. That added $276 billion to the pockets of Americans. And also note that income from businesses did not go down. Well, it would have gone down if it hadn't been for PPP programs, EIDL programs, rent relief programs, but it didn't go down. Would you have really thought that? And then there was all other income. The government also pumped money into banks, into education, into schools, into hospitals. All in all, here's the shocking number. Compared to the same period in 2019, Americans actually had $1 trillion more in disposable income. I wish I could say that the $1 trillion went to those that were in tremendous pain, but we know that's not true. A lot of it went into the pockets of those that didn't need it, people like me, right? But hey, it's money, and those who had more, they spent more, especially on big ticket items like Tesla and Tesla stock and other stocks and real estate. So now you're beginning to understand why real estate and stocks are booming. But income's only one half of the story. There's also expenses. Let me be blunt. COVID scared the shit out of people. And when people are scared, they spend less. Here you can see that they spent $60 more on work chairs and gym equipment, and $60 billion more on work chairs, gym equipment, monitors, webcams. They also spent $39 billion more on food and booze. But they saved an enormous amount of money on services. All that saved money from haircuts and restaurants and flights and concert tickets. It added up to a staggering $575 billion in savings. They also saved $59 billion in interest rate payments because interest rates were lower. All in all, Americans saved a staggering $535 billion. In summary, this combination of $1 trillion in higher income and $535 in higher spending, it pushed America's savings rate through the roof. From March through November, America's savings were a staggering $1.5 trillion higher than in 2019. That's an increase of 173%. Massive. So even as millions of people faced great financial hardship, Americans together in the aggregate, they were building savings at a shocking rate, and the savings had to go somewhere. Some went under with money under the mattress. We've had a lot more deposits in banks. But for those that were a lot more comfortable with risk, there was investing in stocks, in Bitcoin, in real estate, in every other asset class, gold. It all went up. And I know now it makes sense as to why everything is up and nothing is down. All right, that was 2020. Let's talk about 2021. Let's talk about forecast. Look forward into the future. The first thing that we look at is GDP, or simply economic growth. It's necessary for home price and rents to go up. So I am delighted to say that the consensus forecast for 2021 GDP growth are the highest they've been in decades. Typical consensus forecasts have been in the 1.5% to 2% range for the last 10 years. So it's fabulous to see a number as high as 3.56. And last night, Sunday night, right? This is being delivered on a Monday. On Sunday night, Goldman Sachs, the most accurate predictor, wrote a shocking letter. Goldman Sachs' prediction for 2021 GDP is 8%. In its entire history, the United States has only ever been at 8 once, in 1951. Just once. Even China doesn't hit 8% very often. And it's the fastest growing country on the face of the planet. That's a stunning number. Why is it that high as of yesterday? Because we just injected $1.9 trillion more into the economy through the bill that just passed. I think a significant portion of that money was not needed, and is just going to basically, it was there to give the Democrats a big win, and they got their big win. Hey, they passed it, they got the big win. We can argue about all of the whether it should have been done or not. That's not me. You're not here to learn that from me because I'm apolitical. All I can tell you is the impact. $1.9 trillion injected into an already recovering economy will explode our GDP growth. I think that 3.56%, which you see on the screen, is a fantastic number. I think it's too low. And we're worried about inflation, right? In 2020, the inflation numbers were pretty low, right? So you'd see not much here. And so now we're like, oh my God, inflation's coming. The truth is, inflation is being welcomed by the Fed. The Fed wants at least 2.5 to 3% inflation. We are predicting that it's going to jump and double from 1.24% to 2.16, but that's not a bad number. Inflation goes up, rents go up. If you're holding assets, not a bad thing for you. The third indicator is unemployment. 2020, of course, completely off the charts, right? But 2021 should be a more reasonable number. And we think that this number is also low. 2021 projections are at 6.12%. This is before the $1.9 trillion package. Now we're beginning to see somewhere around 5%. Yes, it's higher than it was in 2019, but 5% supports an entire economy. There's not a huge difference in terms of 4% employment and 5%. 4% is where we were pre-pandemic. I think we get back to 5%. It's also likely that by the end of the year, we get back to 4%. So I don't think unemployment is going to hold us back. And our last key indicator is the direction of interest rates. As you know, the Fed has already announced that they're going to hold interest rates low for longer. So we think that interest rates are actually going to stay pretty low. Today, they're a little bit higher than this. This is as of mid-Jan. So we are up to about 3.25%. So another 0.25% above where this rate is. But the beautiful thing is that if you look at the 6 different companies that predict interest rates, their average is 3% for the whole year, which means that interest rates are going to stay low for the entire year. I think they're going to stay low next year as well. I think the 3.03% is a little bit too low. My feeling is with the Biden bill passing, we should be looking at 3.25%, or we should be looking at 3.5% in terms of interest rates. But historically speaking, 3.5% is an extraordinarily low rate. All right, let's move on to migration patterns. This is a trend that is huge. If you're not listening to this, you're going to miss out on an enormous amount of money. Let's find out what happened when Americans moved during the pandemic. Well, as you can see from the picture, it wasn't good news for America's gateway metros. San Francisco, New York, Los Angeles, Chicago, they all lost population to their suburbs. And where there's winners, there's losers. The Big Apple had negative rent growth because people were going to Newark, New Jersey. Denver lost people and rental profits to Colorado Springs. Seattle lost people to Spokane. California just lost people. San Francisco, San Jose, Oakland, Los Angeles, all in the losing team for rents, with Fresno, Sacramento, and Bakersfield as the winners. And so, but people were not just moving from San Francisco and New York to their suburbs. They were leaving the metros altogether. The states in green are seeing huge inbound moves. We invest in Idaho, incredible growth, #1 in the US, no surprise. We also invest in South Carolina, that came in at #2. Then you had Oregon, South Dakota, Arizona, Tennessee, North Carolina, Florida, all big winners in the pandemic super migration. The states in light blue had some inbound migration. Some people moved in, slightly less people moved out. Texas, Utah, Washington, all powerful states are in that light blue group. The states in dark pink, they are the bigger losers, the big losers. California, New York, Illinois, all of the Northeast states, Connecticut, all took massive hits in terms of population loss. That was the states. What about cities? Well, predictably, the big loser was the Big Apple. 5x the population loss compared to 2019. Chicago, San Francisco, Los Angeles also lost a ton of people. And that really hurt them when it came to their rents. The green chart on the left shows 1-bedroom rents in big metros before COVID. Orange chart on the right shows the drop in rents after COVID. Take a look at San Francisco, 24% drop in one-bedroom rents. Remember that rent losses in the great financial crisis 2008 were around 3 to 5%. So 24% is pretty astonishing, right? And it's not like rents decreased. If you look at nationwide median rent, it actually went up 0.6% for single family. So it really was the big metros that got their butt kicked. Another trend to point out, 2-bedroom rents were super strong. 1-bedroom rents were actually weak. People wanted more space. Okay, so those cities that I mentioned were hurt badly. What cities were the winners? So take a look at these 6 that are on the screen. I'm happy to say these 6 were the biggest gainers. They're all markets that we invest in. That's because through our data and analytics, we saw these trends before COVID. The virus didn't start any of these trends. It massively accelerated them, 10x accelerated them. Apart from these 6 that we invest in, other areas of note that gained population up on the screen were Austin, Dallas, surprisingly, a number of slow-moving Midwest markets like Indianapolis. I'm going to skip past this one, and I'm also going to skip past this one. I also want to point out that rents fluctuated. So look at the difference in rent growth between suburbs and urban areas. I'm happy to say that 100% of our properties are in this. So our markets saw robust rent increases, while urban markets were flat to negative on rent growth through the pandemic. Overall, looking at all kinds of properties in the whole country, rents dropped a little bit. Nothing compared to the 2008 Great Recession. You see that number right here, right? You can see that recession hit real estate much harder than this recession. And when you slice and dice it, if you leave out the more expensive Class A units here, rents in workforce housing hardly declined, right? Less than 1%, so no big deal. And that decline actually varied a lot across countries, across cities. You can see how different markets fared. The markets we invest in are in green, right? One of our markets, Houston, saw a tiny drop, but the other 4 markets saw big rent increases, with the market that has our biggest project seeing a huge increase in rents. And what about sale prices? Well, we saw a tiny dip in per door sales prices, a couple thousand per unit. You can see that here. I'm happy to report that this dip has now ended. And in March 2021, that number is up here at an all-time high. Apartments on a per door basis have never been this expensive. And as a result, cap rates in the United States are declining. Cap rates in Q4 were at 5.1. We're projecting that cap rates in this quarter will actually drop to 5, and they will continue dropping by about 0.1% each quarter for the next 4 quarters, which means a year from now we'll be at 4.7 cap. Those of you that understand that know what an incredible number that is. A 0.1 decline in cap per quarter allows you to screw it up in 17 different ways and still make a lot of money for your investors. That's what we're projecting. Yeah, rental collections have been pretty good. All of you guys have seen this graph before if you're in multifamily. Yes, we saw some issues. We saw some delinquencies. Class C especially saw significant delinquency, but it wasn't the end of the world. I mean, basically, rent collections dropped by about 2%. They're beginning to bounce back now. The bill that just passed, the 1.9 trillion, has massive amounts of money for people that haven't caught up yet. I urge you, if you're holding apartments, look at that and start applying. You can get a bunch of money there. There's more than $100 billion as that landlords can get because you're helping your tenants. All right. For a moment, moving away from multifamily, take a look at single family. Single family was a fascinating market in 2020, absolutely incredible. Our story actually starts in 2010. On the left, you see in 2010, nearly 3 million homes in the US were in foreclosure. So landlords like me bought as much as we wanted. I bought 10. But by 2019, that number was down big time. Foreclosures are really not adding to the single family supply. In 2020, foreclosures were banned by the government. In 2021, we expect them to tick up a little bit. But since almost 100% of homes in America have equity, there will be almost no foreclosures. When you have equity in a home, you just sell it. You don't foreclose on it. If the bank forces you into foreclosure, you just sell the damn home. So those of you that are waiting for foreclosures, good luck to you. You're going to be waiting for a long time. Another reason why single family rentals, not multifamily, single family rentals are accelerating wildly is that richer people, more affluent renters are turning to single family and townhome rentals. In fact, this graph shows that since 2012, the percentage of renters making more than $100,000 has gone from 8% of the market to 13% of the market. And these renters are picking townhomes. They're picking single family, not apartments. And the renter demographic in the US is changing. 20 years ago, most renters were young singles. Today, things have changed. Young families are renting more. Middle-aged families renting more, mature families renting more, multi-generational families living together in large single-family homes. And look at that spike in single-parent rentals. All of these groups prefer to rent townhomes or single-family homes. Massive upward pressure. So all this upward pressure is driving single-family home prices up much faster than wages, right? So you see this incredible increase in sales price. The last 12 months was phenomenal. And as a result, what's happening is that as this ratio goes up, home prices are rising much faster than in incomes. So now more and more renters are being created. In the last 12 months, we've created a ton more renters because home prices in the US have been going up wildly. The next 12 months, they're also expected to be the largest home price increase in history. What does that do? It creates renters because they simply cannot afford to buy a home. In fact, today, 50% of tenants cannot afford the down payment to buy a single family home. And that number gets worse every year. So as we create more renters, single family is getting more and more expensive, but renters are also adding into the marketplace. You might say builders are going to build more and fix this problem. The answer is no, they won't. Take a look at it. Except for April and March when the pandemic struck, every single month of the year, builders sold more homes than they did in 2019. 300,000 more in each month, right? So bottom line is it's flattened out. You can see a very aggressive flattening. That's because this is as many homes as you can build in single family at any given point in time. Lumber is 3 times more expensive than it was 12 months ago. You can't build more. The builders are not going to take the gravy cup away from anybody at this point in time. And so we expect to see a massive increase in single family home prices. This 5.7% was before the Biden bill was passed. Now we're expecting somewhere around an 8% increase. We're also expecting, in terms of volume of home sales, for it to be the biggest year since 2006. And it's just, you're going to see incredible things in the single family market in the next 12 months. Realtor.com is projecting a 5.7% increase in sales, in home prices, but that was before the $1.9 trillion bill passed. We think that we're going to come in somewhere around 10%. And because that 10% is across the US, metros that are really hot could see 15% home price increases. That's 3 years of home price increases in a single year. Imagine how many people are not going to be able to afford homes and become lifelong renters. Finishing off with best cities for real estate in 2021. Before I do that, just pointing out what we are doing, what we feel is the appropriate thing to do here. What we're doing is we're building turnkey fourplexes throughout the United States because we feel that investors, sure, they invest in syndications, they make money. The problem is but the syndication gets sold, their depreciation gets recaptured, and they end up paying capital gains taxes. So I became obsessed with the idea of how do I never pay depreciation back? How do I never pay any taxes, not even capital gains? The answer is investors need to buy their own fourplexes. That we feel is by far the most profitable with the highest level of control, 1031 benefits, and still has the benefits of multifamily because even though you have a fourplex, that fourplex is in a community of 100 units. So it's professionally managed by a high-end property manager. We're building these kinds of products, and I'm going to skip past this, in markets throughout the US, Texas, Idaho, and many other markets. Again, they're extremely profitable. Building them in Texas, you guys know everything about Texas anyway. We build them in Houston. Here's what they look like. Very beautiful community, 14 different fourplexes. Each investor is buying one of those. I'm going to skip past some of these. Just want to point out that these are available for those that are interested. Please reach out to us. You can put that information. I'm going to give you my email address at the end of this presentation if you're interested in buying a fourplex and having 100% control and 1031 benefits, not share any of the profits with us. Then please talk with us. We'll be happy to connect you with our fourplex specialists. So that's what we feel at the moment is the right thing to do. All right, let's go back. Finish off with top markets in real estate for 2021. First, I'm going to start with single family. I know a lot of you guys are multifamily. We'll talk about that. But single family, such an incredible list from Zillow, right? I've been screaming about Boise and Idaho for 3 years, screaming about it. Boise comes in at #1 now. I think it was #5 or #6 last year. Tacoma, Washington. This is the Seattle effect. At #4, Spokane. Once again, the Seattle effect. And if you notice, Seattle itself is in the list. So Tacoma and Spokane are seeing the Seattle effect. Killeen is seeing the Austin effect. Austin is the most powerful real estate, in fact, in America. Killeen is 67 miles away from Austin. It's 1/3 of the home prices. So it makes sense that Killeen prices would go up at a crazy rate. In this list, I also like Indianapolis. A lot of you are like, what? He doesn't like Cleveland? No, I don't, because Cleveland doesn't have population growth. And to me, I need Midwest Rust Belt market population growth for me to like them. Indy qualifies. Its population is going up much faster than most Rust Belt cities. I like to do 2 charts. So here's a second one for single family. There's a couple things to point out here. Once again, Seattle shows up at #2, Boise at #3. I do not agree with San Jose at #1. So I'm not going to comment on that, but Seattle makes sense. Boise makes sense. Sacramento is the cheapest market in California. That makes all kinds of sense. Phoenix, rockstar market. It's #6 and 7 are 2 other cheap markets in California. Once again, those make sense. And Denver and Charlotte are always in these lists. They've been in the list for 4 or 5 years, 2 superstar markets. So no issues there. I don't know anything about Harrisburg, Pennsylvania. So that was single family. You notice that Idaho was dominating with Boise there showing up. You also saw North Carolina. You saw Phoenix in one of the 2 lists. So those are the markets that are dominating on the single family side. On the multifamily side, at the top of the list are those 2 cheap markets in California, Inland Empire and Sacramento. You just saw them a minute ago, as Oxnard. Same thing, Inland Empire and Oxnard are very similar markets. And then you see Las Vegas. I'm not sure about Vegas yet. I think Vegas has really suffered in the pandemic. So I think as a market, it deserves to be at #3, but I think it's going to be very rocky because of its recovery. But below that, Phoenix, superstar market. Once again, Indianapolis. Did you notice that Indianapolis showed up in the single family and multifamily list? It's not common for Rust Belt markets to show up on both sides of the list. In fact, it's very uncommon. So take note of that. Atlanta at #7, evergreen superstar market, shows up in these lists all the time. Both of the superstar cities in North Carolina are in the multifamily list, Charlotte and Raleigh. Only one market in Florida, though, Tampa, and that's because Orlando is cooled a little bit because of the pandemic. Generally, Orlando tends to be in this list, but for the moment, it's not. I expect it to make a comeback next year. All right, that's multifamily from Yardi. Once again, I like 2 lists. So I'm going to point out the CBRE list and how that list is different. It really isn't. The multifamily lists are very consistent. You notice that CBRE list also has Phoenix, it has Atlanta, it has Raleigh, it had Kansas City, it had Indy, all of those repeated. I also saw, so here's the full list. I also saw Jacksonville there in the list. That was no surprise to me at all. But the markets that repeated in both lists were Phoenix, Atlanta, Tampa, Kansas City, Indianapolis, and Raleigh. Those were all repeats in both lists. I think all of those make perfect sense. All right. Those were the single family and the multifamily top markets in the US. Time for me to stick out my neck and pick the top market for 2021. I usually pick 2. I pick a dark horse. Last year, I picked San Antonio. For the first time since I started doing these annual presentations, I've picked a Rust Belt city. I'm not a fan of the Rust Belt, but Indianapolis is very, very hard to ignore. Crime remains a concern, but Indy has fast growing population, fast growing income growth, home prices are going up. I'm unlikely to invest in Indy, but I think this market is underpriced and offers some serious bargains for investors. And now, my pick for best city in the US for real estate for 2021 is Phoenix, Arizona. After missing out narrowly for 3 consecutive years, it came in number 2 in our list, 3 consecutive years. I'm delighted to declare this is my top pick. It is the fastest growing large city in America. It has so much going for it that COVID has had almost no impact on its rent growth, on its prices, on its cap rates. I expect that Phoenix is going to continue to fly. The Phoenix will fly in the coming year. That, folks, is our presentation. We do 26 different presentations. They're all like this at multifamilyu.com. So if you'd like to keep joining us on different topics, we're going to talk about student housing, senior housing. We're going to talk about self-storage, mobile home parks. All of those are coming up this year. So you're welcome to join us for those. The industrial one is going to be especially interesting because I do not believe multifamily is the best asset class in 2020. That title goes to industrial. So join us for that one. I think that comes up in about 2 months on multifamilyu.com. And if you are interested in our fourplex offering, which is unique, no one else in the US does what we do on the enterprise fourplex, 100 unit plus fourplexes where everyone owns their own. You're welcome to send an email to me. My email is on the screen. And I'm happy to take your questions at this point. If you have any, because many of you have already, with all that many facts pouring out of your ears, it takes a moment for people to go, is he actually done? Oh my God, that's a lot.
Oh man, that was great. Incredible. So, wow. Yeah, I remember we were talking last, I don't remember, March or April when we had you on the podcast. And at that time, as you mentioned, you were a little cautious. You said we were in a fog. Do you think it seems pretty clear now that you feel that we've come out of the fog? And so
faster than I thought, faster than most other people that I thought. So happy to be wrong.
Yeah. So we did have a couple of questions. I think when you were talking about foreclosures and the selling of houses, there was one, won't the threat of foreclosure, even with equity, prompting them to sell single families, increase the supply of single family homes and drive down prices?
No, Kenneth. If there's equity in homes, the threat of foreclosure simply means that more homes come to market. But with interest rates this low, the market is ready to absorb 20 or 30% more. And the threat of foreclosures is roughly on 6% of the homes in the US. So if the market wants to absorb 20 or 30% more, and only 6% of the homes can potentially even be foreclosures, you've still got an issue where the demand is higher than the supply. So I absolutely do not expect there to be any drive down of prices. I strongly suggest you don't wait for it.
All right, someone asked, please speak to student housing, its state, and what is the way out?
So, student housing was very interesting. Another one that I was wrong on. I was like, boy, are these students going to want to go back? They are desperate to go back. Fall enrollment for this year is extremely strong, and it doesn't look like there's any decline in fall enrollment at all. So look, 2021 fall enrollment looks exactly like it did for 2019. Rents are actually up about 1.5%. So they've taken a hit on the rents in that from 2019 to 2021, there isn't really much of a difference in rents. It's really the same rents. So basically, they lost 2 years of rent growth. But apart from that, things look phenomenal. People, teenagers are sick of being at home and they're desperate to get out. We are not seeing any negative trends. We are seeing a few markets suffer, mostly Californian markets, but outside of California, student housing is doing remarkably well. I'm surprised.
So your pick for San Antonio last year, did it meet your expectations?
Absolutely. I think that San Antonio would have repeated if Indy hadn't done so well. It was the second in our list. It came in second. There's another question from AK, also very similar to Glenn's question. So I'm going to take it together. Do you see San Antonio benefiting from an Austin spillover effect? Absolutely. The Austin effect is the strongest real estate effect in America. Keep in mind that the San Francisco effect, which has been the strongest effect for 3 successive decades, for 30 years, the strongest effect in America was the San Francisco effect. Sacramento benefited from it for 3 decades, especially in the last 5 years. Sacramento is 124 miles away from San Francisco. Do you know how far San Antonio is? San Antonio is 72 miles away from Austin. You can technically live on the outskirts, the northern outskirts of San Antonio, and work in Austin. What's even better is this, that a corridor never truly developed between San Francisco and Sacramento. There's all these fields, right? And there's little cities in the middle. But the beauty is that we've already got tremendous development on that corridor between San Antonio and Austin. There are 2 major cities there, New Braunfels and San Marcos. So that corridor has a significant advantage compared to the California corridor, which wasn't really filled with cities, but still Sacramento took huge advantage. In my mind, the greatest effect is the San Antonio to Austin corridor. And it makes more sense to invest in those cities in the middle, New Braunfels and San Marcos, than it does to invest in Austin or to invest in San Antonio. But by themselves, I think those two are pretty darn powerful. I don't see that changing at all. The Austin effect is set to run for the next decade.
It's funny. I actually went to San Marcos and I was a lifeguard at Schlitterbahn in New Braunfels. And I just have to say they've been working on that corridor for about 35 years now.
It's their time. There's a lot of work that was put in. There's a bunch of other tiny cities in there as well. That corridor is going to become some incredibly profitable real estate. I wish I could find more there. How difficult is it to manage properties without physically being in the vicinity of the property for extensive periods of time? Extremely difficult for single family, not very difficult for large multifamily, because large multifamily has staff on the property. So if your property manager works at the property, your maintenance staff live at the property because you give them discounts, your leasing agent works at the property, how can that be hard? If you have 4 employees that report to you, work at the property, and 3 of them live there, how can that be hard? So you talk about cap rate declining, but you stated this still provides opportunities for investors. Yes, Jameson. Cap rates declining, a decline in cap rates means an increase in prices. So if you knew that prices were going to increase in the future, and that's what I'm suggesting to you, wouldn't that be an opportunity? Isn't that good information to know now before prices go up?
So if you're underwriting deals now, would you be using that cap rate that's 1% lower for your exit?
No, I'd be using the same cap rate. No, investors would beat the shit out of you for doing that. But what I would do is I would argue that we should no longer be, putting a cap rate that is higher than our current cap rate. So we've been doing that for a long time. I think that it doesn't make sense to do it anymore.
So a lot of investors, include ourselves, are underwriting properties by projecting no rental growth for the next 12 to 24 months. Is that something that you do at Grocapitus?
I think things have changed with the new Biden bill. Again, I know if you're a Republican, you're wincing that this is a Democrat win, but hey, whoever's in power throws money at people. The Republicans threw plenty of money at people last year, didn't they? So I think that the truth is that it's a lot of money. And I think that at this point, we're about to see some inflation. So I would be careful about rent growth in the next 12 months. I think that rent growth is going to be just in that 2% range. I don't think it's going to be a little crazy. But what I'm very confident about is that cap rates will compress. You may not be able to raise rents on people that are still suffering. But with the market flooded with $4 trillion, there's a lot of money chasing very few assets. So I am not suggesting that we're about to see a ridiculous increase in rents. I'm not at all suggesting that. I'm suggesting we're about to see a ridiculous increase in prices. All right. Surprised to see 3 cities in California on the list. Why? The California cities that you're seeing are the cheap cities in California. I know they're really expensive, when you compare them to the cities everywhere else, but Californians like to invest in California. These are cheap cities, so they want to buy stuff there. Let's see. Boom, boom, boom. I think I answered all of these questions. Let me go back down.
I think that's all the questions.
George, anyone who started finance? George, anyone? No, I don't know George, anyone. Sorry. There you go. I think I answered all of the questions in that list. We're happy to continue that conversation on the web, on Facebook, or on multifamilyu.com. George Antone, yes, George is a friend of mine. Yes, so George Antone and I have spent quite a bit of time together. Yes, George is an absolute genius when it comes to deal structuring.
Yeah, small world. So just to give another plug to Multifamily U, I too myself go there to look for a lot of information, because you do a lot of webinar, a lot of good webinar, really good information. Wherever you are in your investment career, you will find some value in that information at multifamilyu.com. So please take a visit over there and educate.
Thank you, Hutch. That's $20 for you.
No, we like you, Neal. We really do like you. We do appreciate the value that you bring all the time with your crazy self.
Thank you. I hope to stay crazy and get crazier.
Absolutely.
Thanks,
Absolutely.
everyone. Thank
Kind
you.
of crazy. Take care, Neal.
Alrighty. Bye-bye, guys.
Oh, there was one more question, if y'all got time.
Yeah, absolutely. So Neal bounced.
Oh, damn.
But I think we have enough people in here to answer these questions. We got some experts to see Uncle Glenn over there.
It's in the chat.
Okay, it's in the chat. Oh, you can voice the question, Levy.
It was about the California.
Okay.
Yes, it was about the California cities. They were mentioned on the list, several of them. San Diego was one of them that I noticed had an influx of people to the population.
Right.
I was just wondering his opinion on what he thought about rental options there as far as making purchases and whatnot.
Okay, yeah. So you give a couple different matrix that a lot of syndicators look like, all syndicators look at, was if you have the population growth and you have the job growth and income growth. I mean, population growth, job growth, income growth, and also increase in home value, right? You have a good matrix to make a good assessment of purchase in that market. Does that make sense?
Yeah, I'm
okay.
Tracking.
Yeah. So yeah, definitely reach out to him. If you send questions to him on LinkedIn, he will personally answer those questions. Yeah, man. So what were you saying about a VA?
Yeah,
loan?
man, dude. I told Brian too. I just feel like, you specifically and Brian, right? You both have such a great platform for veterans. I know that, there's others, there's Valkyrie, the Valkyrie guys, and I think that all of you guys should do the best you can. Like I don't have a platform as far as the military side, just because I've always focused on the roofing. All I care about is investors like you, referring me so I get more roofs so I can make more money. But, deep down, I very much care about my military, family. And so my VA loan, what I didn't know that sometime last year, I think it was January, they got rid of limits, so each state used to have limits for VA loans. So like in Colorado, when I bought my first house, the limit was like 313. I bought for 260. Now it's based solely on income. There's all kinds of different options. Like say me, you, and Brian wanted to go in. We can each get, I think, a 4 or 5 plex combined. So you can get a bunch of guys together and get like a 15 plex. And you can share VA loan. There's crazy stuff that you can do. I had no idea. But I found out
that's still no money down.
Yeah.
What?
Yeah. And if you have disabled vets, you have no funding fee. So like I'm a disabled vet, I have no VA funding fee, which is a big cost. So like the place I bought, because I make like, 200 grand a year or whatever.
Right.
They're like, hey, you can afford $4 million. And I'm like, no, I can't, you're crazy. But I bought this $1 million place, nothing down. So my down payment was $1,123.
Get the fuck out of here.
Yeah. And it was 2.5% interest. So my mortgage is $4,800. This place is a 3,500 square foot house. It has 1,000 square foot 2-bedroom apartment that I have to rehab. Like I'm definitely spending 100 some odd grand on the house and the apartment and the shop, but totally worth it. The shop I'm making $1,350 a month. I'm renting that out. The apartment I could easily, in this town, I could probably make $3 grand if I wanted to, but I'm giving it to somebody at church for $1,400. So just between those two, I'm making $3 grand a month.
Yeah.
So my mortgage is $1,800. But I kept my old place. I had to switch that obviously to get my eligibility back, but that one's at 3.125% refinanced into an investment property. That was my VA loan that I put nothing down when I had no money back in the day. And I'm doing a corporate lease there, and my mortgage there is $1,900. I'm getting $3,800 a month. So
Wow.
I have no mortgage, like between this $1 million place and the other place.
Yeah.
And I'm like, this is unbelievable. Like
It's
every
crazy.
veteran ever needs to
Holy
know
crap.
this. And we need to figure out how to get more guys taking advantage so they're all successful and they're all, doing what you're doing,
Yeah. So we can buy more than 4 units now, or just?
I think it's 5. I think they changed it to 5. But
Yeah.
again, if you combine it with people, like a married guy like yourself or me, your wife's probably not going to be cool with that. But the single guys, like briefly when you were in the break, you put us in the breakout before, Bawa came on. I talked with 2 guys and they were like, dude, we got to talk. So, I mean, that's what I'm saying. Like just my story, like that quick, these guys are like, are you serious? Like, we got to do this, and I didn't even know much about the, doing the VA loan combined. So that's another thing I want to look into a little more, but yeah, from my understanding, like Brian said, I think if you had, what was it? 2 guys or something, you can get 10 units. So I think he was saying you could have 5 now instead of a quad. It used to be a quadplex.
Yeah, I thought it was 7. So the numbers I would need to narrow down.
Yeah, I don't know. Who knows? I
mean, but
I'm sure
that's crazy, man.
Talk with my mortgage guy.
Yeah, that's pretty cool.
So
especially if there's no limits. Now, if he was to buy a 4-plex, would they consider a portion of the income from that multifamily properties as the rental
as my
income?
own income, you're asking?
Yeah.
I would think so. I mean, I guess I don't know. I have a really good lender that I can definitely talk to about. Just, again, my focus was this one first time, but I'm definitely looking at, okay, what can I do next? I mean, as my income increases, to your point, I have all this rental income now from these other places. So if I refinance this one and then do this again and buy a $4 million place with, 10 units or whatever, I don't know, I'll figure it out. Or buy a house that has a bunch of land, like this one is zoned R2, and I can split it 3 more times. So I'm probably going to put 2 sets of duplexes in the back. So I'll end up having this apartment, my house, the shop, and then 4 duplexes in the back, like, again, upfront cost, but it's like, why wouldn't I do that? Like this land is only going to go up here.
Yeah. It's in Cali?
It's in Golden, Colorado.
Okay. Oh, yeah. Okay. Colorado.
Yeah.
Okay, man.
So, yeah. So I just figured I'd let you know. And, like I said, you're a baller. I'm nothing near you guys, but I figured you guys can't.
That's not even close. We're not even nothing close to
Nah,
what you're doing.
You guys are doing awesome. I love what you're doing.
If you get your lender and your lender dive deep into that information, we can have him present on our meetup. That'd be great.
Yeah, absolutely.
Yeah.
No, I mean, again, I just think that it's just a powerful thing for these, especially the young guys or the guys transitioning out, whatever it is, it's like, this has got to be in front of people and let them see what this can do. Because nobody talked about that when we were, when I was in. I don't know if they talk about it when you're in now.
No, the mission.
Yeah.
Yes,
So.
man, I'm really hoping when I go back to the squad and I'm not distracted by creating wealth.
Yeah.
I was so focused on retiring this October, man. I'm really myself back into it.
You're gonna stick around longer.
I think I will.
Yeah.
Got selected for E9, and it's been a lifelong dream of mine.
Dude, that's
24
awesome.
months.
Congratulations.
Yeah, thanks, man. I can still do this while I'm on active duty for the next 24 to 30 months.
Yeah.
So
that's really special, and that's exciting. My what was it? My NCO, when I was enlisted, he just got selected as chief for Korea or whatever, so he's leaving in May. I just messaged him yesterday.
Oh, wow.
So yeah, exciting stuff. So yeah,
man, I'm gonna end this breakout room. Close all rooms.
Sorry.
No, they got 6 seconds. It's all good. Yeah, man. I'm definitely interested in what your lender have to say about
yeah, I'll chat with him.
Yeah, service member using the VA to purchase multifamily.
Yeah.
Cool.
I'll definitely I'll get back to you on it.
Yeah, I know a lot of the younger Marines, they house hack.
Yeah.
Where they get buddies to come live with them. But if they can all team up and buy some duplex and triplexes in Cali, right?
Exactly.
That does a lot for them.
Yeah. No, I mean it's unreal. I mean, it really is, like, so many different options that it opens up for them that they can do really good things. And it's like about freaking time you do something good for us after we get out.
I know, right? Well, it probably was always been there, by the time we get educated on it, right?
Exactly.
Yeah. So Jameson, Levy, and one other guy.
Yeah, I talked to Baxter and Jameson earlier.
Okay.
Now that we're all back in, so yeah.
But yeah, man, that information is game changer, and yeah, we can definitely serve the country and definitely create a great future for families, and that's amazing to have that possibility. Yeah.
Agreed.
All right, how was that?